Apa news ini lihat? Non alcol. Betul mereka tadi. Ante Ivano, nah verbi. Kira-kira tu itu lagi cikgu renda. Tu Good evening.
Good evening, Mwalimu.
Good evening, sir.
How are you?
Good, Mwalimu. How are you?
I'm fine.
You're feeling okay now?
Yeah, I'm better. I've actually recovered.
We thank God.
Yeah, we thank God. I'm fine now. I think I'm fine.
All right. Good help.
Thank you. Are we likely to get quorum for this meeting, really?
Let them like a minute and see.
Me, on my side, I highly doubt.
Yes. Are we likely to get quorum? Because a number of you guys are doing exams, eh?
Exactly.
So what do? Do we continue or we do what now? So far, you're only two. Some are coming in, I can see. Some are coming in. Eh?
Mwalimu, maybe we give it like 10 minutes and see if we'll have quorum. If we won't, then we could send us a recording and we deal with that.
You know, it's very difficult to record. It's very difficult to record when no one is listening.
Or you don't have it ready?
No, I don't have it ready. Unless now I do
Oh.
it and I record as we do. But I can see guys are coming. Eh? I can see guys are joining.
Let's give them a minute and see.
Yeah, I can see guys are coming. This concept is tricky. Even if I gave you the notes, what I'm almost sure is that you'll struggle trying to understand where it starts and where it is moving to. I know you have been reading these option trading strategies. I'm not very sure whether you guys connected the issues well. Eh? But I wanted to, of course, because of limited time, I may not be able to go through all the strategies, but I wanted to take you through so that you understand how the concept is built, so that even if you move to other strategies, I think you can be able to connect. Option trading strategies is a very, very challenging section. I know I shared notes with you in the Moodle. I want to believe you have been looking at them, but I know that is not a concept which is very, very direct. Eh? I'd also shared with you, I did share with you a recorded video on how to design swaps, financial swaps. I want to believe that you guys were able to follow the signing of swaps. In my summary, which I have here that I have not typed, the small summary that I have on this issue of option trading strategies. What I shared with you on the signing of swaps is also a section which is here. I'm going to share with you these notes in your Moodle, the handwritten notes, which I've scanned and I've shared on the signing of swaps. But there's a section of option trading strategies. I tried to summarize what I shared with you. Sorry, I was pushed out of the meeting. Eh? Sorry, I was pushed out of the meeting. Now, I was saying that I talked about options when I was going through the introductory part of this course. When I talked about financial derivatives, or the market for financial derivatives, one of the derivative instruments that I talked about is an option. Recall we talked about a forward, a future, swaps, and an option. And I went further to discuss pricing of options using the general valuation models, using the Black-Scholes model, using the binomial option pricing model. So we understand what is an option, and we understand the various types of options. that is a call option and a put option. I know that that one you appreciate very well. Now, when we talk about option trading strategies, in this case, it's a combination. It's a combination of option. These are combination of options of the same type or different types. You can buy, for example, a call option with a given strike price and sell a call option of a higher strike price. Or you can buy a call option of a higher strike. I mean, you can buy a put option of a higher strike price and sell a put option on the same option of a small strike price. So in this case, these are trading strategies that you can enter in an effort to manage financial risks. A number of option trading strategies. It's possible to manage financial risks by entering a number of option trading strategies. And these trading strategies can basically be classified into two. We have spreads and combinations. It's a risk management strategy. Option trading strategies are basically a risk management strategy. So we have two types of these options. We have spreads and what we refer to as combinations. Now, spreads occur when you take a position in two or more options of the same type. If you take a position in two or more options of the same type. What I mean is this: you can buy a call option of a small strike price and sell a call option with a higher strike price. You are buying a call option and selling a call option. So you are taking a position on options of the same type. You can buy a put option of a given strike price and sell a put option on the option of another strike price. So when you take a position, on two or more options of the same type, like now, for example, the bull spread and bear spread, you'll be taking a position on two options. When you bring in the butterfly spread, you'll take a position on three options. So the first type of an option trading strategy involves spreads, where I've said you'll take a position on two or more calls or two or more puts of the same type. Yeah, so you can buy a call option, sell a call option. You can buy a put option and sell a put option. So that gives rise to what we are calling spreads. But combinations is an option trading strategy that involves taking a position in both calls and puts on the same stock. You can buy a call option with a strike price of K1 and sell a put option with a strike price of K2, or the vice versa. You can sell a put option with a strike price of K2 and buy a call option with a strike price of K1. So you're taking a position. You're taking a position in both calls and the put options. Now, for us to be able to understand the concept of option trading strategies, we need to appreciate a concept that we refer to as options algebra. There's something we refer to as option algebra, and we'll be seeing it as we continue discussing. And you see, this is what I'm saying there. In order to appreciate how option trading strategies can be applied to manage financial risks, we need to understand the concept of option algebra. What is this option algebra? This is a series of +1, 0, -1 values assumed by a number of strikes of each strategy. Oh, sorry, I muted myself. I muted myself. You know, I muted myself. So where did we stop at? I've just discovered I'd muted myself. Eh?
Spread.
Spread.
You had algebra, options algebra.
Okay, yeah, so I've said that options algebra are a series of +1, 0, -1 values assumed by number of strikes of each strategy. And this can be summarized. The summary of the profile diagram as shown below. You can see the diagram that I have here. You can see there's something we call a long call, a long put, short call, short put. It's important that we appreciate those terms. Long call takes that kind of a pattern. Hiyo mnaona namna hiyo. Is a long call. Long call means buy a call option. A long call means buy a call option of a given strike price. This is a long put. You can see the shape of the long put goes like this in a panda hivyo. Long put means buy a put option. Anytime that we talk about long, you're buying. A long call, buy a call option. A long put, buy a put option. A short call, sell a call option. Short call, take that position, naenda hivyo, nashuka chini. A short put, narudi nyuma namna hii, narudi chini, take that shape. Short put, sell a put option. Short call means sell a call option. So short has to do with selling. So when you talk about a long call, buy a call option. Long put, buy a put option. A short call, sell a call option. Short put, sell a put option. Now, it's important that you see the shapes that they are taking. This is a long call. Move like this, you go up. Long put, you move like this, you go up. A short call, you go like this, come down. A long put, you go backward and come down. Now, I've already said that optional algebra are a series of +1, 0, -1 values for each strategy. And look at the shape. Look at the shape of those +1, 0, and -1. When the line is moving up like this, +1. You see, I'm trying to tell you, if you see the line is moving up, +1. If the line is moving across, 0. If the line is coming down like this, -1. Series of +1, 0, and -1 values of each combination of strategy. The aggregate of the various strategies gives a final payoff of a strategy. And I've already defined those terms: long call, short call, long put, short put. So it's important for you to see the shape of the line. Panda namna hiyo, that is +1. It goes across 0, and when it comes down, that is -1. Okay, today I wish to talk about spreads, and I'm going to talk about bull spread and a bear spread. I just want to talk about those two: how to build a bull spread and a bear spread. I've already said that spreads, you are taking a position on calls or puts of the same time. Whether it's a bull spread, whether it's a bear spread, whether it's a butterfly spread, you'll be taking a position on calls or puts of the same time. The first type of a spread is referred to as a bull spread. I don't know whether from your background of financial institutions and markets, you guys are familiar with a speculator in financial markets known as a bull. Are you guys aware? One of the speculators in financial markets known as a bull. There's also another speculator in financial markets known as a bear. Are we familiar of those speculators? The bull and the bear. Are you guys familiar with those speculators? Anaitwa bull, mwingine anaitwa bear. Or when a market is showing bullish signs, what does that mean?
Prices are going up.
Yes. When the market is showing bullish signs, it's an upward movement, which means you expect prices to go up. You are speculating a price increase, isn't it? And therefore, ordinarily in that market, you can buy stocks when the price is low so that you can sell that stock at higher price.
Yes, yes.
Now, when the market is showing bearish, I think my internet is misbehaving. Sorry, my internet seemed to be misbehaving. I was talking of bearish signs, a market showing bearish signs. Bearish means a downward movement. So a bear is a speculator who can sell. You sell at a higher price to avoid a situation where the price will go down and lose. So if you anticipate a price reduction, then you'll sell.
Mwalimu,
You can sell at the top of the market when the price is higher to avoid a situation where the price will go down and sell stocks at a smaller price. So when we begin talking of the bull,
Mwalimu, you are breaking. We can't even get what you are saying.
Mwalimu.
are you guys getting me? Are you getting me?
You are breaking.
So are you getting anything? Are you getting anything? Tafuta stool, uinue hiyo kitu juu. Kila stool pale juu, uinue hiyo ruta kidogo. Are you guys getting me? So are you getting me? Are you now getting me?
Yes.
My internet is misbehaving a bit. If you're getting me, we can go on. I went back to remind you of speculators in financial markets we call a bull and a bear. And we are in agreement that a bull is one who will buy stock, maybe at a small price. You expect the price to go up and sell at a higher price. The reverse applies for a bear. A bear you'll sell at a higher price because you expect the price to go down and you don't want to lose. Now, a bull spread is created by buying a call option. It's created by buying a call option on the stock with a strike price of K1 and selling a call option on the same stock with a higher strike price. Please take note, created by buying a call option on stock with a strike price of K1 and selling a call option on the same stock with a higher strike price. So in that case, you are taking a position on two options of the same type. You are buying a call option with a strike price of say K1 and selling a call option on the same stock with a higher strike price. In that case, K1 has to be less than K2. Now, why do you enter into a bull spread? An investor enters a bull spread with the hope that the strike price will increase. I think that confirms what we have already talked about, because you are a speculator who expects a price increase. So an investor enters into a bull spread with the hope that the stock price will increase. So bullish signs are characterized by an upward prices in the market. Of course, we have talked about that. I've already reminded you that. Consider the following strategies: a long K1 call, short K2 call. Long K1 means what? From what we have already said, a long call means, are you guys able to remember what we said? Long call. A long call, you are buying a call option. A short call, you are selling a call option. So a long K1 call means buy a call option with a strike price of K1. Long K1 call means buy a call option with a strike price of K1 and sell a call option with a strike price of K2. Short K2 call means sell a call option with a strike price of K2. Consider the following strategies. Already we have done that interpret. This implies that K1 has to be less than K2. Now, there is something we call the stock price, which is a random variable. You know, price can change from time to time. Even when I was going through option pricing, remember stock price was a random variable. Remember I went through the basic option pricing. When you are valuing a call option or valuing a put option, the stock price could change, but strike price okay, you guys may have to bear with me because I have a challenge with my internet. It looks to be misbehaving. Eh? Okay, so if you're getting me, we can proceed. We're going through this the bear spread, the bull spread. I've said consider the following strategies: long K1 call, short K2 call. And I've done the interpretation. So long K1 means buy a call option with a strike price of K1, and then sell a call option with a strike price of K2. I was saying that stock price is a random variable, which means the price can change from time to time. We can consider the price before the strikes, that is before the strikes, price between the strikes, and the price after the strikes. There are three scenarios. If K1 is less than K2, then we can look at the stock price below K1. The stock price lies between K1 and K2, and the stock price which is more than K2. Yeah, below K1 means before the strikes. Between K1 and K2, that is in between the strikes. And then if the price is more than K2, that is after the strikes. K is the strike price, can be K1 or K2. You recall from our basic evaluation models, we said value of a call option is maximum of the stock price less exercise price or zero, whichever is higher. I hope you guys remember that. From our background of valuing a call option, the basic approach is that value of a call option is the maximum of S minus E. I think in class, I talked about S minus E. So here, the same S is the stock price, which is a random variable, minus K1. Now I'm using K1 here. I mean, I'm using K. In class, I was using capital E. So the stock price minus strike price or a zero, whichever is higher. So because we are buying a call option with a smaller stock price and selling call option with a higher strike price, then we need to know the value of a call option in that manner. Before I come back here, let's come down to let's come down here to this diagram that you are seeing here. I did tell you how the shape goes. The long call, the short call, the long put, the short put. I hope you guys remember. This is something that I told you here. Look at the shape of the long call. Buy a call option. Long put, narudi nyuma unapanda. Buy a put option. Short call, namna hiyo unashuka. Sell a call option. Short put, namna hiyo unashuka. Sell a put option. Now look at the shape, this shape here. Look at that shape. Now, along the y-axis, that's where we have profit and losses, the profit or loss. Along the x-axis, that's where we have the prices. Which prices? You can show the strike price and the stock price, which is a random variable. Remember, we have already said, suppose we buy a call option with a small strike price, K1, and sell a call option on the same stock of a higher strike price, K2. So along these axes, you can show the strike price and we'll show the stock price, which is a random variable. Along this axis is profit or loss. Look at the shape. Long call, look at where I've positioned K1 and K2. Ukiangalia hapa chini, I've gone all the way up to K2, and then it goes up like that. I hope you guys are seeing that. Are you seeing that? I've gone across up to K1, strike price of K1, then you go up. Long K1 call, long K1 call, buy a call option with a strike price of K1. If you show it diagrammatically, you move across up to K1, it goes up. Okay. You remember this was the shape of the long call. You saw the shape of the long call from the onset. Angalia the shape of the long call. You can see, you go like this and it goes up. Long call. Short call, you go like this, comes down. Let's go back to our diagram. Long call. Unaenda namna hiyo up to K1, it goes up. Short K2 call, you go across up to, you see K2. The strike price is K2 and come down. I hope you guys can see this. This is a long call, and that is a short call. But more importantly, look at the positioning. You'll go across up to the strike price of K1, then you move up. Go across up to a strike price of K2 and comes down. Remember our option algebra. Remember our option algebra. Let me take you back again to the option algebra. An upward movement in the line, +1. When you go across, 0. When you come down, -1. Now let's look at the diagram. Look at the long K1 call. From here up to here, what value will you assign? +1.
Plus.
From here up to here, what value will you assign? Again, it's a long K1 call. You're moving across. So you assign which value? 0, isn't it? I'm mess out.
0.
When you go up, +1.
Upon is 0.
When you go across, 0. When you go down, -1. Therefore, just observe here. Long K1 call. Tutaenda kwa short K2 call. Let's look at so you agree that is 0, eh? From our background of option algebra, from here up to here, you're moving across, that is 0. So we are looking at a long K1 call before the strikes. The strike is K1 and K2. From 0 up to K1, that is before the strikes. K1 up to K2 between the strikes. K2 and above, that is after the strikes. So look at before the strikes. If you consider a long K1 call before the strikes, that should be 0. Hapo tuko pamoja?
Yes.
Now, how about in between the strikes? Look at what's happening. In between the strikes, what value will you assign?
+1.
That is +1. Okay? In between the strikes, between K1 and K2, +1. How about after the strikes? After K2 still is going up, that should be +1 again. Eh? Okay? Are you guys noticing that? Eh? We are considering a long K1 call. Before the strikes, 0. Before means no K1. Now, between the strikes, K1 and K2, the line starts going up, +1. After the strikes, after K2, the line is still going up, +1. This is what I have summarized somewhere here. The long, over to one, angalia, long K1 call. Unaona hapo, eh? Before the strike, 0. Between the strikes, -1. After the strikes, -1. Are we together up to there? Are you guys with me up to there?
After the strike, -1. I'm seeing it.
What happens after the strikes? After the strikes, what is happening to this line? This is a long call.
This
Long K1 call goes up to K1 and is going up. Long call. So before the strikes, 0. Between the strikes, 1. After the strikes, still 1. Eh?
Okay.
This is a short K2 call. You have to go across up to K2 and come down. So what happens before the strikes? Before the strikes, that is from 0 to K1, that is 0. Eh? So now, moving across, yes. That is 0. Between the strikes, K1 up to K2,
it's 0.
0 again. After the strikes, -1.
It's -1.
Correct. Now, this is what I'm showing here. Please, you need to understand the concept of optional algebra. Otherwise, you could not understand anything. Eh? Not upper. So short K2 call 0, 0, minus 1. Tumeona namna hiyo. So what's the total payoff before the strikes? 0 plus 0, that is 0. Eh? Before the strikes, the payoff is 0. Between the strikes, if you take minus 1 plus 0, is that minus positive 1? Eh? Are we together?
Yes.
Yes.
After the strikes, minus 1, positive 1 plus minus 1, is that 0? So the final pattern, the final payoff is that before the strikes 0, between the strikes positive 1, after the strike 0. And this is what I'm showing here in this diagram. Eh? Can you see what like I'm shading? Now. What I've shaded, I'm trying to show you that before the strikes, that should be 0. Between the strikes, between K1 and K2, you see you move from K1 here up to K2 here, plus 1, and after the strikes, 0. Are you seeing that? Eh?
Yes.
So this shape is the one that you are seeing here. This shape is the one you are seeing here. I'm seeing 0, positive 1, 0. I'm sure in your notes you saw this, but maybe you don't understand how it's coming back. This is 0, positive 1, 0. We expect the final payoff to be as follows: 0, minus 1, 0. Okay, I think that's very, very important. But again, before I look at a small illustration, let's go back to this schedule here. I've told you, recall, that value of a call option is the maximum of stock price minus exercise price or 0, whichever is higher. Please, let's be a bit attentive here. Kama kuna yule amechelewa kidogo, kama kuna yule amelala kidogo, tafadhali muamuke sasa hapa in this schedule, because when you're deciding the payoff of a bull spread, that becomes very, very important. Look at that table there, that summary. We have the stock range. Which are these stock range? The stock price less than or equal to K1. This is before the strike, eh?
Yeah.
Huh?
Yes.
Je, hizi zote tumeona hapo kweli? Tafadhali. If the stock price is less than or equal to K1, that is before the strikes, isn't it?
Yes.
If K1 is less than stock price and the stock price is less than K2, this is between the strikes, isn't it? If the stock price lies between K1 and K2, that is, I'm sorry, if K1 is less than ST, but then ST is more than K2, this is between the strikes. ST is less than, yeah, that's okay. So the stock price lies between K1 and K2, that is between the strikes. And if the stock price is more than K2, that should be after the strikes. So please take note, before the strikes, between the strikes, and after the strikes. Eh? At the back of your mind, please remember what you have talked about here. Stock price is a random variable. It can be less than K1, can lie between K1 and K2, maybe more than K2. But one thing for sure, if the stock price is less than K1, then it means it's obvious that that price is less than K2, isn't it? If the stock price is less than K1, it's obvious that the other stock price will be less than K2. If the stock price is more than K2, it's obvious that the price will be more than K1. That one you infer straight away. Eh? Okay, now let's come to this schedule before I look at a small illustration. What happens if the stock price is less than or equal to the strike price, K1? And please take note, Please take note that is a payoff from a long K1 call. E column E is a payoff from a long K1 call. This column is payoff from a short K2 call. Please let that be very, very clear from the onset. What I'm showing in this column are a payoff from a long K1 call. What I'm showing in this payoff, in this column, are payoffs from a short K2 call. Then we will find the total payoff. So let's first consider a payoff from a long K1 call. What happens if the stock price is less than or equal to K1? Come to this formula. Value of a call option is the maximum of the stock price minus strike price or 0, whichever is higher. So what happens if the stock price is less than or equal to the strike price? What is the value of a call option? Before the strike. If the stock price is less than or equal to the K1. So what happens here? What becomes the value of a call option? If the stock price is less than the strike price, the difference here will be negative, isn't it? If ST is less than K, the difference here will be negative, eh?
Yes.
So if the difference is negative and you compare with this 0, which is the maximum?
0.
Maximum is 0, isn't it?
Yeah.
That's why I'm saying a payoff of 0. What if K1 is less than the stock price? What if K1 is less than the stock price? What becomes the value of a call option? If K1 is less than the stock price, what becomes the value of a call option?
Positive.
The difference here will be positive, isn't it? So that difference answer here, which is positive, if you compare with the 0, which is the maximum? Should be ST minus K1, isn't it?
Yeah.
Cindy?
Yes.
Now, calm down. Calm down. If stock price is more than K2, if stock price is more than or equal to K2, it goes without saying that that price is more than K1, isn't it? If the stock price is equal to more than K2 after the strikes, it goes without saying that that stock price is more than K1. Inequality.
Yeah.
Therefore, the value of a call option still remains stock price minus K1. Stock price minus K1. So these are the payoffs from a long K1 call. Okay, now at the back of your mind, from our option algebra, you know how that algebra looks like? At the back of our mind, you guys know how it looks like. Maybe go back again. This thing, if I don't take it slowly, what to happen watapotea. Nirudi tena nyuma kidogo kwa hii diagram. Before the strikes, tulisema you assign a numerical value of what? 0, isn't it? Before the strikes, you are moving across, you assign a numerical value of 0. So the 0 multiplied by 0 should remain 0. 0 multiplied by 0, here the back 0, eh? Ni kweli. Now, in between the strikes, we assigned a numerical value of how much? Do you guys remember? In between the strikes, CD is going up, positive 1. And after the strikes, the line is still going up, positive 1. So once you take,
Positive.
yeah, so once you take ST minus K1, you multiply by 1. That does not change. Sindio?
Ngoja niwashe hivyo.
Ni hapa juu. On this payoff of mine, your payoff iko wapi? Where we were calculating the value of a call option. Hapa. So 0 times 0 remains 0. ST minus K1 times 1, no change. And the stock price minus K1 times 1, no change. Hapo mnaona mzuri tafadhali, eh? Je, tuelewane hapo, eh? Before the strikes, numerical value of 0 times that value of an option 0 remains 0. ST minus K1 is the value of a call option between the strikes times 1. So that will not change. ST minus K1 times a numerical value of 1, because after the strikes, you saw the line is still going up. So these are the payoffs. Now, please be careful. Be careful with the payoff from a short strike price of K2. We'll be selling a call option with a strike price of K2. And from our diagram, please check what's happening again. Let me remind you. From this diagram of mine, you see this is a short K2 call. You go across up to K2 and it comes down. So before the strikes, whatever answer you find, for value, finding the value of that call option, you'll multiply by 0. You can see the numerical value before the strike is 0, between the strikes is 0, and after the strikes, minus 1. Before the strikes, 0, in between the strikes, 0, after the strikes, minus 1. Haya, turudi kwa formula yetu hapa tena. Now, let's consider the other payoff. Payoff from a short K2 call. Payoffs from a short K2 call. Now, before the strikes, angalia sasa hapo tena, if the stock price is less than or equal to K1, it goes without saying that that stock price will be less than K2. Si ni kweli? Before the strikes, if the stock price is less than or equal to K1, then it goes without saying that that stock price is less than K2, isn't it? Yeah, tunaelewana hapo. Tunaelewana hapo ama tumepoteleana?
Umepotea.
Kwa nini tunapotea? We have gone to a short K2 call. Short K2 call. Kutoka kwa diagram, simeona kutoka kwa diagram. Hii ni short K2 call. Goes here mpaka K2 unashuka. So before the strikes, 0. In between the strikes, 0. After the strikes, minus 1. You have it at the back of your mind. So if the price lies anywhere here, if the stock price is less than K1, it's obvious that that price is less than K2. Sindio? Stock price ikikuwa less than K1, it is obvious that that price will be less than K2. Sini kweli?
Yes.
Surely you guys are taking so long to see that. Are you guys taking so long to see that? Surely you should see that quickly. Now, if that is the case, let's go back to our formula. If the stock price is less than K2, then the difference here must be negative, isn't it? If the stock price is less than K2, the difference here should be negative or 0, whichever is the maximum. The maximum is 0. Now, if the stock price is less than K2, again, if the stock price is less than K2, then it means the difference here will be negative or 0, whichever is the maximum. Maximum is 0. But we say before the strikes, there's a numerical value of how much? 0, isn't it? Do you guys remember this surely?
Yes.
So 0 multiplied by that 0 remains 0. In between the strikes, a numerical value of 0 from our optional algebra concept. 0 times 0, that is 0. Now, after the strikes, we have to be careful because the line started going down. Now check. If the stock price is equal to or more than K2, what happens now? I think here I should have said more than. Should have said more than, not equal to. If the stock price is more than K2, so value of a call option should equal to what? Stock price minus K2, isn't it? Hebu angalia hapa mzuri, if the stock price is more than, if this is more than K2, then the value of a call option will be stock price minus K2. However, from our optional algebra, that line is going down. Multiply that by minus 1. Stock price minus K2, that is ST minus K2. Then put a bracket times minus 1. What does it give you?
Minus.
Stock price minus K2, the whole of it, multiply by minus 1. Can you open the bracket?
Okay,
Minus
Positive.
Yes. Now, when I say value of a call option is maximum of stock price minus K2 or 0, what is the value of a call option? If the stock price
0.
is more than K2, if the stock price, if this is 10, that is 5, what becomes the value of an option?
5.
5.
5. Now, I don't want to use any figure. If the stock price is more than K2, it means the value of that option will be ST minus K2, isn't it? This will be higher than that, eh?
Yeah.
But you multiply
Yes.
the whole of this by minus 1. Can you open the bracket? After the strike, so the line is coming down. So from our concept of optional algebra, you multiply by minus 1. That is minus ST plus K2.
Yeah.
If you take minus 1 times ST, that's minus ST. Minus 1 times this, so it becomes K2 minus what? ST. Isn't it?
Yes.
That is the payoff that I've shown here. That's how I arrived at K2 minus ST. So please, you need to be very, very careful because that concept of optional algebra comes in. So before the strikes, the total payoff, 0 plus 0, that is 0. Between the strikes, ST minus K1 plus 0. So you add now the total payoff. That stands, if you take this plus that is ST minus K1. Now, if you take ST minus K1 plus K2 minus ST, if you add, what becomes the final payoff?
Majimoto.
ST minus K1 plus K2 minus ST. What's the final payoff? Unapata ngapi?
K2 minus K1.
That is what I'm showing here. Isn't it?
Yes.
So this is a total
Yes.
payoff. So when you are designing a bull spread on a call, whichever call, if you are designing a bull spread on a call, these has to be the final payoff. Before the strikes, the answer should be 0. Between the strikes, ST minus K1, and after the strikes shall be K2 minus K1. But of course, if there's a cost for you to get the profit or a loss, 0 minus the net cost, ST minus K1 minus the net cost, K2 minus K1 minus the net cost, be able to get the profit or a loss. Okay, there's a small example here that I've done. Just check this small example. An investor buys shillings 3 a call option with a strike price of 30 and sells for shillings 1 another call option with a strike price of 35. Show the profit pattern for the bull spread. I think clearly this is a bull spread because you'll be buying a call option with a small strike price and selling a call option with a higher strike price. So it looks like 30 is the equivalent of K1, 35 is the equivalent of K2. Now, we're required to show the profit pattern for the bull spread. First thing that you have to do is to find the initial cost. If this guy buys for shillings 3 a call option, and then he sells for shillings 1 another. So if you buy a call option at 3 shillings and sell another call option at 1 shilling, so how much have you spent effectively? That is 3 minus 1. So the net cost is 2. The net cost is 2 because you spend 3 shillings buying a call option and you have sold this call option at 1, that is an income. So 3 minus 1, the net cost is 2. You have seen from this illustration, our K1 is 30 and our K2 should be 35 because you're buying a call option of a small strike price and selling a call option of a higher strike price. So it goes without saying that K1 is 30 and K2 is 35. Remember, value of a call option is the maximum of the stock price minus exercise price or 0, whichever is the maximum. So we have the stock range price. This is before the strikes, between the strikes, and after the strike. So I've picked the column for the final payoff. In this case, please have it at the back of your mind that whichever call option you're deciding a bull spread, this has to be the final payoff. So I've picked 0, ST minus K1, K2 minus K2. That is the total payoff. So those are the ones I've picked. Those are the ones which are picked here. 0, ST minus K1, K2 minus K2. So if the payoff is 0 here, and you spend a net cost of 2, that should be a loss of what? You take 0 minus the net cost 2, that's a loss of 2 shillings, eh? Isn't it? So before the strikes, the payoff is 0 minus 2, that is minus 2. Between the strikes, the final payoff is stock price minus K1. I have not given any answer for the stock price. If it's given to you, you'll pick that stock price. We know K1, that is 30. So stock price minus 30 minus the cost, net cost, which is 2. That becomes stock price minus 32. So whichever value, remember the stock price is a random variable and take any form. So that value, whichever value minus 32 should give you the profit or loss. We kuja hapa chini, K2 minus K1. K2 is 35, K1 is 30. The difference between 35 and 30 is 5 minus the cost. I think there's an error here. I forgot to remove 2. If you take 35 minus 30, that is 5. Minus 2, that should be 3 shillings. Eh? Hapa kuna error. So when you receive the notes, please adjust. It's K2 minus K1 minus the net cost. 35 minus 30 is 5 minus 2. That is a profit of 3. And by the way, what we are trying to imply that as long as the strike price, as long as the stock price is more than the strike price at K2, you'll always obtain a profit of 3. As long as the stock price is more than K2, whichever price you pick, you'll always find a profit of 3. And I've tried to justify that argument here. I've tried to justify that argument here. Alternatively, assuming in the same illustration, K1 is 30, K2 is 35, and the stock price is 35. Let's assume stock price 35. Then, you know, profit is equal to maximum stock price minus K or 0 minus maximum stock price minus K2 is 0. So long K1 call, a short K2 call. If you pick the maximum, stock price 35 minus strike price 30 or 0, the value of that option should be 5. 5 minus 0, that is 5. Of course, here you can see this side, that 5 minus that 5 is 0, or 0, that is 0. So 5 minus 0, that is 5 minus 2, that is just 5. So that profit after the strikes will be 3. But suppose you pick another price like 100. In the same formula, profit is equal to maximum stock price of 100 minus K1, which is 30, minus 0. The maximum is 70, minus 100 minus K2, which is 35, or 0. That should be 65. 65, when you compare with the 0, that is 65. 70 minus 65 is 5, minus 3, that is 3. Even if you pick 200, even if you pick a stock price of 500, the profit shall remain at 3. Going by our diagram, the profit shall remain at 3, as long as that stock price is more than that strike price of K2. So we have been able to design or show the profit or loss payoff of a bull spread. Now, the other possible spread is a bear spread. I think I want to talk only about these two, bull spread and the bear spread. At least from there, you will have connected. Even if you go through the butterfly spread and look at combinations, it should make sense for you. The other type of a spread is referred to as bear spread. I've already told you from a background of financial institutions and markets, when a market shows bearish signs, a downward movement. So a bear who is a speculator will buy at the top of the market, sell at the top of the market and avoid a situation where the market price will go down and you will lose. So you need to have that at the back of your mind so that you can connect it here. So suppose you buy a put option with a higher strike price, maybe K2. I've decided now to use a put option here. If you buy a put option with a higher strike price K2 and sell a put option on the stock with a lower price of K2, what does that mean? When you buy a put option that is a long K2 put, yeah, remember I've told you long put, you are buying a put option. A short put, you are selling a put option. So a long K2 put, that means you are buying a put option with a strike price of K2. A long K2 put means you are buying a put option with a strike price of K2. A short K1 put means you are selling a put option with a strike price of K1. Now, when you come to our diagram, I think I did show you the shape it takes. So kama mnakumbuka from the onset, I brought in those diagrams here. You see, long put takes that shape. A short put takes that shape. Long put unarudi nyuma unapanda. Short put unarudi nyuma unashuka. Look at this diagram again. Same thing is what I'm showing here. This is a long K2 put. Unakuja hivi mpaka K2 inaendelea kupanda. Yeah, unakuja hivi, this is a long K2 put. So you come down, come back up to K2 inashuka. From our concept of option algebra, you can see after the strikes, that should be 0. Between the strikes will be -1. Before the strikes remains -1. So na inapanda juu. That means before the strikes, -1. In between the strikes, -1. After the strike, 0. That applies to a long K2 put. Higher, short, kuja namna hiyo, short K1 put. So you come down, come across up to K1, inashuka. So that means before the strikes, -1, after the strikes, 0. Sorry, in between the strike, 0. And see in between the strike, 0, after the strikes again, 0. So please have that at the back of your mind again. And this is what I'm showing here. Look at the long K2 put. Before the strikes, -1. Yeah, a long K2 put. Before the strikes, -1. Between the strikes, -1. After the strike, 0. This is a long K2 put. Before the strikes. Unaona hiyo line inapanda, inashuka chini hivi. So before the strikes, -1. Between the strikes, -1. After the strikes, 0. That is what I've shown here. -1, -1, 0. Short K1 put. Between the strikes, +1. Between the strike, 0. After the strike, 0. That's what I've shown again here. -1, 0, 0. So when you come to this summary of mine, I think it is very, very clear there. See, imeenda wapi? Yeah, so short K1 put. Before the strikes, you saw is -1. In between the strike, 0, 0. So the final payoff before the strikes, +1 plus -1 is 0. 0 plus -1. Between the strike is -1. After the strike is 0. So you see, if we were to sketch, we end across, we end chini, alafu we end across. 0, -1, 0. That is what I have shown here. This is 0, 0 before the strikes, unaenda hivyo. In between the strikes, you come down. That is 0, -1, 0. That's the final payoff. Okay, there's a small example here that I've shared with you. An investor buys for $3 a put with a strike price of 35, a higher strike price, and sells for $1 a put with a strike price of 30. Show the profit for the various stock price range. So he's buying at 3, selling at 1. The net cost is still 2. The stock price range before the strikes, that is ST less than 30. My K1 now is 30, K1. 30 less, that the stock price lies between K1 and K2, lies between 30 and 35. The stock price more than 35. So it's important, the total payoff. I don't know what I showed. I did show you how to get the final payoff. Hiyo sikuonyesha. You need this final payoff. And this is what I've worked out here. Generally, the payoff table will appear as follows. If the stock price is equal to or less than K1, if the stock price lies between K1 and K2, and if the stock price is more than K2. Now we have a short K1 put payoff. Remember, this is a put. And from the formula for valuing put option, you guys are aware. What is the formula of valuing a put option? Value of a put option is the maximum of what? Strike price minus the stock price or 0, whichever is higher. Value of a put option is a function of the maximum of the strike price less the stock price or 0, whichever is higher. So if the stock price is less than, let's consider short K1 put. And at the back of your mind, please remember the shape of that curve. Short K1 put before the strikes, 1. Between the strike, 0. After the strike, 0. Once you have established the value of a put option before the strikes, multiply by -1. The value of a put option between the strikes times 0. Of course, that becomes 0. And after the strikes, multiply by 0. That remains 0. Okay, now just check in this shape here. Short K1 put. So if the stock price is less than K1, at the back of your mind, you know the formula for finding the value of a put option, the strike price minus the stock price. Strike price minus the stock price. So if the stock price is less than K1, then the value of a put option should be K1 minus the stock price, but multiplied by -1, because before the strikes, you saw from the option algebra, the line is coming down. So that is -1. If you open the bracket, stock price minus K1. If the stock price is less than, if the strike price less than the stock price, value of a put option is strike price minus the stock price. So that answer will be 0 times -1, it becomes 0. If the stock price is more than K2, then it is obvious that that stock price is more than K1. It's obvious the stock price will be more than K1. So we shall take the strike price minus the stock price, but after the strikes, you multiply by 0. So the short K1 put payoff is ST minus K1, 0 and 0. I think ideally here the answer must be 0 because between the strikes, the option algebra value 0, and after the strikes is 0. Now, if you consider a long K2 put, you also need to remember it's a long K2 put. You can see before the strikes, -1. Between the strikes, -1. After the strikes should be 0. Then you do the same argument. You do the same argument. So if the stock price is less than K1, it means that price less than K2. So the value of the option will be K2 minus the stock price, multiplied by 1. That one does not change. If the stock price is less than K2, then it is obvious the value of a put option will be K2 minus ST times 1. That one does not change. But if the stock price is more than K2, then the value of that option will be means 0, multiplied by 0, that remains at 0. So you can see before the strikes, the final payoff, ST minus K1 plus K2 minus ST. I think ST goes, and therefore should be K2 minus K1. The final payoff is K2 minus K1. Here, 0 plus this, the final payoff is K2 minus ST. 0 plus 0, the final payoff is 0. This is what we need when you're deciding a bear spread of a put. Then the final payoff should be K2 minus K1, K2 minus ST, 0. So in that illustration, which is going through, this is what we need. I think that's what I've picked as the total payoff in that small illustration that, so you pick K2 minus K1, K2 minus the stock price and 0. I think that's what I've picked in that illustration. If that is what I've picked, yes. K2 minus K1, K2 minus the stock price or 0. So K2 is 35, K1 is 30, so 35 minus 30, that is 5, minus the cost of 2, we have a profit of 5. So that means if the stock price is less than, the strike price, then we expect a profit of 5. In between the strikes, final payoff is K2 minus the stock price. K2 is 35, minus whichever value is the stock price. I've not picked a value, minus the cost. So that becomes 33 minus the stock price. After the strikes, total payoff is 0 minus 2, and it becomes a loss of minus 2. So this becomes the profit or loss from designing what we refer to as a bear spread. Okay, I have done that those short notes so that it opens up your thinking on these strategies. One thing you can confirm, it's not a very direct thing, you guys can see. It is something that requires a lot of thinking and understanding the option algebra. But perhaps I need to share with you again this recording so that you can go through it on your own. What I've taught you, I will put it in your Moodle and I will share the recording so that you can go through it on your own again. So I just wanted to talk about those spreads, the bull spread, the bear spread, so that you can see what's happening, so that when you go to your notes, you go through butterfly spread and you go through combinations. Maybe, you know, in combinations now, you can buy a put, sell a call, or buy a call, sell a put. This topic is not direct, it's not very direct, but if by any chance you find it in an exam, at least you can scribble something. India, I don't know whether it is there, what exam has been set. But if you find it in an exam, I'm sure you can scribble something. Empty to make a zero, you can scribble something, just in case these concepts have been set. At least I'm sure you're able of scribbling something.
Yeah.
So let me stop there. I think I'll share with you the recording again so that you can go through it, and those who are doing the exams can listen. Sawa. Hiyo ni sawa.
Sawa.
Thank you.
Karibu.
Thank you, Mwalimu.
Karibu.